Okay, chapter 6. So last week we did a little bit different than what we had been doing for the first 4 chapters. And we looked at the variable costing, looking to see how to take those costs, bring them into your products. And today we're going to do kind of the same thing, but it's a little bit different. We're going to be doing absorption costing and comparing what we did last week to what we're doing this week. So for this chapter, we're using actual costing rather than a normal costing approach that we use in job order costing. So again, we're just looking at actual costs. We're not doing that predetermined overhead. And then we're looking at the actual numbers that were produced as the allocation base and assigning actual fixed manufacturing overhead costs. And it always assumes that the variable manufacturing costs per unit and total fixed manufacturing overhead per unit remain constant. So we'll look at the costs, they're going to remain constant. The only thing that's going to change in our scenarios is probably either the quantity or maybe a sale price. Okay, so when we did variable costing, we were looking at our product costs, which was direct material, direct labor, and we did variable manufacturing overhead. So the fixed manufacturing overhead, the variable selling and admin, and the fixed selling and admin were considered period costs. We're going to switch it a little bit for absorption costing. So we're going to look at variable manufacturing and fixed manufacturing overhead is going to get added in with direct materials, direct labor for product costs, and just the selling and admin, fixed and variable, is being part of the period costs. So the first question it asks is which method would produce the highest values for work in process and finished good inventories? And the answer is A, absorption costing. So we'll walk through examples. You probably don't understand this right now, but what'll happen is with the absorption costing, we're going to take that fixed cost and we're going to look at how many units were produced, and some of it's going to stay with product that hasn't been sold yet. So since it's staying in the wherever it's at, work in process or finished goods, that will make that absorption cost a little higher in those accounts because we're not pulling the whole thing out into cost of goods sold. So we'll walk through so you understand what that means. Okay, so we have Harvey Company produces a single product, the following information. So we're producing 25,000 units annually. The variable cost per unit, we have direct materials, direct labor, and variable manufacturing overhead at $10, and selling and admin at $3. Then it gives us our fixed cost. So we have manufacturing overhead at $150 and selling and admin at $100. So it'll break this out for you so you know what numbers to pull in when you're trying to calculate for your units when it's telling you what's sold and what's still left in inventory. All right, so we're going to compare the two. So absorption costing, we have our direct material, direct labor, and variable manufacturing overhead, $10. I need to write it down as we're going through. So those numbers are just coming from this slide, from what was given to us. And I think we're going to stick with those numbers. I think it's on all the examples the same. $150 and $100. Okay, I just wanted to write those down real quick. Okay, so then under absorption costing for the fixed, because remember that first slide we talked about bringing in that fixed manufacturing overhead, we have to figure out how much is that per unit because it's only giving us a total dollar amount for the fixed. So the fixed manufacturing overhead was 150,000. It's telling us that we're producing 25,000 units per year. So we're just going to do the math on that to come up with what it is per unit. So we get $6. Our total unit product cost is $16. So for variable costing, we're only bringing in that variable manufacturer overhead, not the fixed. So it's just the $10. Okay, so we're gonna assume 20,000 units were sold during the year at a price of $30 each. There's no beginning inventory. And we're gonna look at the variable costing and the absorption costing to compare the income statement. Okay, so we have 20,000 in sales, 20,000 unit in sales times $30. That's how we're gonna come up with our sale price. Then we're gonna have variable costs at that $10, which was on that previous slide. Remember, we saw it was just $10. So we're gonna take 10,000 times 20,000 because that's what we sold. We get 200,000. The variable selling and admin is 20,000 times $3. That was given to us on that very first slide. So we're just taking 3 times 20,000, give us our 60,000. Okay, then we have total variable cost of 260,000. So when we did variable costing, remember we were looking at that contribution margin last week. So this is how it's laid out, similar to what we were looking at last week. So we have our selling price, and then we have our costs for variable. So that gives us our contribution margin, 340,000. Less fixed expenses, which was given to us. So we had fixed manufacturing at 150 and fixed selling and admin at 100 for a total of 250. So our net operating income is 90,000. So now we're going to look at it using absorption costing. So now we're going to add in that fixed variable. Okay, so we have $30 times 20,000, same selling price. Cost of goods sold. So remember the table that had the $16. This one. So we had the fixed manufacturing overhead that we have to add into that variable manufacturing overhead. So we calculated that out to be the $6. So now our cost is $16 versus that $10. So it's a little higher. All right, so we have 20,000 times 16, that gives us 320,000. So our gross margin is 280,000. Less the selling and admin expenses. So variable was $3, gives us 60,000, and then we have that fixed selling and admin, which was 100,000. So now our fixed costs are only 160,000. So you see how they did that? They pulled out that whole 150,000 that was in that fixed manufacturing overhead, and now they're breaking it out per unit. So not the whole 150,000 is in there now. So now our net operating income is 120,000. So remember, let's go back one. So remember the other slide showed that the net income was only 90,000. It's because all of those fixed costs were coming out of that contribution margin. Whereas with this, you're only bringing in the cost of the fixed expenses per unit. So we don't have the whole 25,000, we have 20,000 because that's what we sold. So where does that other 5,000 go? So that's what we're going to look at. So remember I was saying that it could be in work in process or finished goods. So in this example, we have 5,000 in finished goods. That's going to be carrying some of those costs of the fixed expenses, and it won't come into the income statement until you sell those goods. So remember that inventory is a balance sheet account. So as long as those finished goods are in inventory, that cost is basically sitting on your balance sheet, okay, in that inventory. And then when you sell it, it goes through. So if it's in work in process, which is also an asset account, some of those costs may be in there. If it's in finished goods, some of those costs are in there. And that's why absorption costing has a higher cost there than when it comes through from your sales. So depending on how you're producing, what's in inventory when you start the month or the period is going to change and fluctuate your net operating income. And we'll look at an example of that too. Okay, do y'all understand so far what's happening? So in the bottom it says fixed manufacturing overhead is deferred in inventory. Deferred just means that the cost isn't coming through yet. It's going to come through in the future when you sell that. That's what the deferred means, just deferred cost for later. So we have 5,000 units times that $6. So remember we did the math, 150,000 divided by the 25,000 units was a $6. So that's where that's coming from. So now we have 30,000 that's included in inventory on the balance sheet instead of reducing our net income. So we have a little higher net income. All right, so we have cost of goods sold under absorption costing of 120,000 for our fixed manufacturing expense, because it was 20,000 times the 6. And then we have in the ending inventory is the 5,000 units times the 6, so we have 30,000 there. So that total fixed expense is 150,000. So when you compare it to the variable costing, you can see that the period expense of the 150,000 comes out of the entire, the whole cost comes out of the 20,000 that were sold. So that's why there's a little bit of a difference. So this is just kind of nice, kind of shows you how it lays it out for you so you can see it. Does that make sense? You have any questions? Okay. Okay, so now we're going to reconcile the difference. So basically just make sure that it makes sense. So a variable costing net income of 90,000. We have that deferred cost that's sitting in inventory of 30,000. And when you add them together, it gives you the 120,000, which is what the net income was for the absorption costing. And then it just gives you that formula again. We had the 150,000 in fixed. We divided it by the number that was produced, which in this example is 25,000 for the year. So we end it with $6 per unit. 25,000 units produced. We sold 30,000 this time. Units in the beginning inventory, 5,000. That's the 5,000 that we had that's coming forward. We have unit sales price, $30. Variable costs, just the same, the $10. Selling and admin, $3, same fixed cost. So we're looking at the same example, except this time we have 5,000 in beginning inventory and we're selling 30,000 units. Okay, there's our chart again, showing us our cost per unit for absorption cost and variable costs. Okay, so for variable costing, we have 30,000 units sold at $30, so at 900,000, less our variable expenses. So variable cost of goods sold was the 30,000 times 10, so 300,000. And then we had that $3 for the variable selling and admin times 30,000, so we had 90. It gives us a total of 390,000 in expense. So the contribution margin is 510,000. Now for variable cost, and we bring in the fixed expense and pull them out. So we have fixed manufacturing 150, fixed selling and admin 100,000 for a total of 250. Take the difference with the net operating income, and we have 260,000. Okay, so now we're going to do absorption costing. So we have 30,000 units times the sales price gives me 900,000. Cost of goods sold is 16 times the 30,000. You have 480. So that gives us a gross margin of 420,000. And then for our selling and admin expenses, we have the variable 30,000 times 3, which is 90,000. The fixed selling and admin was 100,000. So we have 190 for a total operating income of 230,000. So we have fixed manufacturing overhead that was released from inventory. So remember we had 5,000 units at the $6, which is the 30,000. So that's now it's sold. So it goes into your cost of goods sold. So we're going to reconcile them back. Variable costing, net operating income, 260,000. So we have to deduct the fixed manufacturing cost released from inventory. So that's at 30,000, 5,000 times the 6. So the 30,000 is reducing the 260. So we have absorption costing, net operating income of 230. So you see what happened is it went down a little bit this time because we pulled it out of the inventory. Okay, so for our costing method, so first period for absorption costing, we have 120,000, variable 90, and then the second period 230, variable costing 260, and then the totals of both 350,000. So it's just a timing difference, right? So eventually, when you look at the two side by side over the course of the periods, because you sold those units in the next period, it works out to be the same. It was just timing. And it's not always going to work out that perfect, where you have 5,000 that weren't sold and then they sell in the next period. It's not always going to work like that in real life, but just it's good for the example to show you how that works. Okay, so the units produced equal the units sold. So if that's the case, if we're saying we produced this many units and we've sold that same number of units, then what happens with inventory? There's no change, right? Because whatever went in comes out. The relationship between variable and absorption costing, they're going to be the same because all of those units went through. So it doesn't matter where you put the cost, everything's coming through. Does that make sense? Okay, so if we have units produced is greater than the units sold, so that's what happened in our first scenario. So now our inventory cost goes up because some of those fixed costs are in the product that's still left behind that hasn't been sold yet. So inventory is going to increase and your absorption income is going to be greater than your variable income. Because why? The variable income's picking all of that expense up where the absorption cost is not. What's left in inventory stays in inventory. So it's going to, the variable costs will have less income. Then if we do the second scenario where we have units produced is less than the units that we sold. So now our inventory costs will decrease because we're pulling some of those costs that were in from the previous period. We're pulling those out and now we have a little more out than what's been produced. So it's going to reduce the inventory. And then for the absorption income, it's going to be less than the variable income. Okay. Do you have any questions on that? Kind of understanding how that works. So variable costing categorizes cost as variable and fixed. So it's much easier to use this income format for CVP analysis. So because absorption cost and assigns fixed manufacturing costs to units produced, so $6, remember that $6 per unit for that company, a portion of the fixed manufacturing overhead resides in the inventory and it stays there while they're unsold. Potential result is positive operating income when the number of units sold is less than the break-even point. So we just walked through that scenario so you could see that. Okay, so variable cost and income is only affected by changes in unit sales. It's not affected by the number of units produced. As a general rule, when sales go up, the net operating income goes up and vice versa. So remember, all that fixed cost is in there. So of course, if you sell more units, it's going to have a higher income for you. Absorption cost and income is influenced by changes in unit sales and unit productions. So remember, it fluctuates depending on what's left in inventory and then what you're selling. If you have some inventory that's coming in, that's why it's fluctuating between both what's being sold and what's being produced. Maybe this month the production was less than what was actually sold. So net operating income can increase simply by producing more units, even if those units are not sold. So remember that scenario, when we produce more units than we're actually selling, then we have better net operating income. Okay, so variable costing correctly identifies additional variable costs incurred to make one more unit. So $10 per unit for Harvey Company. It also emphasizes the impact of total fixed costs on the profits. So because absorption costing assigns fixed manufacturing overhead cost to the unit produced, which is at $6, it gives the impression that the fixed manufacturing overhead is a variable with respect to the number of units produced, but it's not. So the results can be inappropriate pricing decisions and product discontinuation decisions. So we're going to look at, I think they have an example in here of why you may think, like with different segments and looking at things, how the numbers sometimes, depending on how you're presenting them, may look like it's negative when maybe it's not. So we'll look at that. I think they break out an example in the segment part. So we have segments. So what that means is you have different activities within the organization. So it's going to be, each one's going to be its own segment. So a segment is any part of or activity in an organization which a manager seeks cost, revenue, a profit data. So we're going to look at it and see, can we look at this segment versus this segment to see where we're making money, where we're losing money. It's helpful for internal managers to make decisions if they need to discontinue a segment. So maybe they're producing this type of product and this type of product, you got A and B isn't really selling, it's not doing good, it's got high costs. And so maybe that segment is just losing money. And if you eliminate it, then the company will look more profitable because then you sell an A, which is doing really good. So you may make a decision to get rid of B. So that's why sometimes they'll do it. So your segment can be an individual store or a service center, a sales territory. So can you think of an organization that would maybe have different cost segments within itself? Think about an organization that does multiple things. Can you think of one? What about a car dealership? What does a car dealership have? What departments? Think about it. You go in, you buy a what? A car, and it can be this or that. Is it what kind of car? New or used. So those could be different segments. You could be looking at what's my profit center look like for my new cars? What's it look like for my used cars? What else do they have? You bring your car in for service. So you have a service department. So then you can look at that segment and say, okay, well, how much is this dealership making from the service department? Because cars are coming in, you get parts coming in, you're fixing those, you have labor. So you have all these different costs that go on it, and you're selling those services, right, to fix the car. So that's its own little cost center. What other department does it have? Well, we did the sales, new and used, sales of services, and what else? So the finance is going to kind of go with the sales. What goes in the car? They have to get what? Sometimes people just come in and buy them, and sometimes the service department's buying it. Parts, right? You got to have all these different parts on a car. So we have a parts department. The parts department is ordering products, right? They have all their parts in there, and they're selling them to the service department, or they're selling them to people that are coming in that need parts. So maybe my husband's fixing my car and I just need a part. So he's going to go in and get the part. Or maybe it's Joe's, car shop on the corner that's fixing your car, and they have to go to the manufacturer to get a particular part. So the parts department is selling to a bunch of customers, not just people that bought cars from there, not just the service of the vehicles that are in there. They're also selling to other mechanic shops. So they have their own segment. What's one more segment that you can think of? Think about a car crash. A collision center. So sometimes they also fix cars. So they have their own segment. So you see how within that organization, there's all these different departments that are making money. And you can single them out, and you might say, let's look at what's happening with the collision center, because maybe your collision center is not doing good at all. It's constantly losing money. Is it worth having that division when you can just outsource that? So you may make a decision to get rid of the collision center because the collision center is not making any money. There's a lot of collision centers that's all they do, and they may be more efficient at it or whatever. So you may choose to get rid of that. Okay, so there are two keys to building segmented incomes. So a contribution format. So remember that contribution format is that variable costing where we're looking at sales minus that variable expense to get your contribution margin. So it's separating the fixed from variable costs, and it enables the calculation of the contribution margin. And then traceable fixed costs should be separated with common fixed costs to enable the calculation of the segment margin. So it just means like we have a bunch of fixed costs. And so sometimes they're traceable, meaning, oh, I know that this cost is directly associated with my collision center, or, oh, I know this cost is directly related to the service department. So think about the service manager. That's all he's doing is managing the service department. He is traceable to the service department. So if you don't have the service department, you don't have that salary. You won't have that fixed cost anymore. So you can trace some of these things to that spot. Maybe the collision center is in its own little building and you have all these fixed costs that go with that building alone. And you can get rid of all those costs if you close the collision center. So it's telling you that there's traceable fixed costs that you can assign to a segment. But then there's people like CEO or accounting or admin, marketing. Maybe they're doing a little bit of everything and some parts are getting, allocated to those departments, but you can't really trace it to one department. So those will be a common expense that you're not saying, okay, let's take these and stick them on the segment. We're just going to look at those as separate fixed costs. So when you look at your financial by segment, maybe those fixed costs are just in a separate section, and we'll look at an example of that. Just means it's traceable to a segment. So traceable fixed costs arise because of the existence of a particular segment and would disappear over time if the segment itself disappeared. So similar to what we just said with that example of having a manager over a particular department, and then they're not there anymore once we get rid of that segment. So examples of traceable fixed costs include, so we have the salary of Fritos product manager at PepsiCo is a traceable fixed cost of the Fritos business segment of PepsiCo. So you see how they're in that Fritos. So if they got rid of Fritos, then they wouldn't have that person anymore. They wouldn't have that fixed cost. And then we have the maintenance costs for the building in which Boeing 747s are assembled. It's a traceable cost to the 747 business segment of Boeing. So if you're not producing the 747 anymore, you're not going to have those salaries, right, for someone to be in there, or you're not going to have maintenance costs for that plane if you're not producing that plane or servicing that plane anymore. No longer have that segment. So you can see how some things are traceable and they would be attached to the segment and would go away if you don't have that segment any longer. All right, so common fixed costs arise because the overall operation of the company and would not disappear if any particular segment were eliminated. So the CEO of PepsiCo isn't going anywhere because they're not producing Fritos anymore. So they're still going to have that fixed cost. That's what that means. It's not going to be eliminated. So we have some examples. The salary of the CEO of General Motors is a common fixed cost of the various divisions of General Motors. So we're not going to get rid of the CEO because maybe we're not going to produce Mustangs any longer. Is Mustang General Motor? I don't even know if it is. Probably not, huh? Ford is what? That's not General Motors. That's different. I don't know. We'll just go with it for tonight. The cost of heating a Safeway or Kroger, which is in our terms, Rouse's, or what's another grocery store? Robert's, Winn-Dixie. So a grocery store is a common fixed cost of the various departments. So just because you're not selling, maybe Rouse's has a segment that they are selling hot foods and crawfish and stuff. Maybe they get rid of that segment, but they still going to have to heat the building. That doesn't go away. So that's just a common fixed cost that will not go away if we don't have the segment. So it's impossible to realize that traceable fixed costs of one segment may be a common fixed cost of another segment. So, well, we'll look at that. So for example, the landing fee paid to land an airplane at an airport is traceable to the particular flight, but it is not traceable to the first class, business class, economy class passengers. See, so they have all these different classes within the plane, but those costs to land it, those are particular to that and can trace that, but you can't trace it to the class of the passenger. All right, the segment margin, which is computed by subtracting the traceable fixed cost of a segment from its contribution margin, is the best gauge for the long run profitability of a segment. All right, so we have our fixed costs. Some are traceable, some are common. They won't get allocated to the segment. I promise we're getting to an example. It's coming in the next slide. Weber Inc. has two divisions. We have a computer division and we have a television division. All right, so we're going to look at the television divisions. That's kind of tongue-tied. Television division income statement. All right, so we have our approach to segment reporting uses the contribution format. So we're looking at it the sale price less the variable expense. So we have sales of 300,000. Variable cost of goods sold is 120,000. So we have other variables of 30,000. Total variable expense 150. So our contribution margin is 150. So with 300,000 in sales less that 150, contribution margin is 150. We have traceable fixed expenses of 90,000. So the division margin is 60,000. So now maybe on top of that, we're going to have some common fixed costs that will have to come out of that. And so the net operating income will be a little lower. Okay, it's kind of the same slide. All right, so here we have television and computer broken out separately, and then we have the company. So here's our television section that we just went over with our sales and contribution margin, our fixed costs. And then here's computer. So if you add them going across for the total, so the total column's just taking both segments and adding together. So we have a division margin, the total division margin of 100,000. And now we may have some common expenses that we have to deduct from the income that we're getting on multiple segments. And then we'll have a net operating income. So our common expenses are 25,000. So remember, those aren't assigned to a segment. We're just going to deduct that after we have the segment income and we total that, then we'll deduct it. So our total net operating income is 75,000. So does that make sense? You have your segment incomes, you're looking at those, less your common, and then you deduct it to get your net operating income. So fixed expenses, traceable to one, fixed expenses that are traceable to one segment can become common fixed expenses if the company is divided into smaller segments. All right, so let's look at an example. So we have regular and big screen TVs. So here's our television. So we just looked at the television as a segment. We didn't break out what was being sold within the television department. That sounds better than television division. All right, so we have our regular TVs and we have our big screen TVs. So we can look at the breakdown of our sales, our variable expenses, contribution margin, what's traceable and fixed costs for each segment to come up with that product line margin. So we have regular TVs at 60,000 and then we have big screen TVs at 10,000. So maybe we're selling little TVs too, and we see that we start losing money, and then you might want to eliminate selling those TVs. So you make decisions on that. All right, so our total traceable fixed cost is 80,000. Now we have common expenses of 10,000. So instead of having 70,000 as our net operating income, we have to deduct that. So now our division margin is 60,000, and we might have some more fixed expenses that are related to other parts that you can't trace to the television department, which means this potentially could go down even more. Okay. So now we're looking at the same thing that we were looking at a minute ago. We had our regular TVs and our big screen TVs. Those are both in the television division. So maybe we want to increase sales by 5%. So we're going to increase our sales by 5%. Okay, so they show the increase in the numbers. This is, see if it gives you, this is where we were. We were at 200 and at 100. And now we're at 210 and 105. All right, our variable expenses, and then we have our fixed expenses, which stay the same. The contribution margin changes because we've changed how much we're selling. We have a margin increase for regular, 52.50 is our difference. And then we have a margin increase by the 22.50 for the big screen. All right. Now we have our division, we have 5,000 in additional advertising. So the division margin, instead of being, I think it was 60, now we're at 62,500. So we made a couple of changes. It's just showing how those changes can be broken out in the segments, and you can look at it even further in that. So we have one segment that's broken out even further into a couple of different little segments. So you can do that to do analysis to figure out if you want to close something. Do I want to sell more of something? Is it worthwhile? How much am I going to have to spend to be able to increase the sales? So that'll be marketing, that'll be you. All right, so now we have our income statement where we're looking at the television and the computer, the company as a whole, and we have net operating income of 75,000. So the sales in the television are 300 and the sales in the computer are 200. So let's go back. It's going back to the original information. So we're not on the example any longer with the 5% increase. Okay, so we're back on where it's showing you a total of 300,000. This is the breakout, but this is what's coming over onto that slide, is this section here. So we're here. Okay, so we have our 60 in income and television. Common expenses are 25, so net operating income is 75,000. So on the homework, you'll have somewhere you have different divisions. You'll have to put those numbers in there. Fill in your common expense to get your net operating income. All right, so we want to do the break-even point. So we want to know, where do we have to be? What's our break-even point in order to make sure that we don't lose any money? Okay, so the break-even point, we have to take 170,000, which is the fixed cost. So it's the traceable fixed cost, the 170, plus that 25,000, which was that common fixed cost. So you take your whole fixed cost at the top and you divide it by that contribution margin ratio. But they're telling you how to do the contribution margin ratio down here. So we went over that last week. So you should have those formulas to know how to calculate that. So we're looking at 270,000. That's our contribution margin for the company as a whole over the sales, which was 500,000. Okay, so we have our contribution margin divided by the sales to get the contribution margin ratio, which is 0.54. So for the break-even point, we take the total fixed cost divided by the 0.54. That gives us our sales to break even. Can break it out by the different segments. You do the same thing. So you have your break-even point. Your 90,000 is your fixed cost under your television section. Figure your contribution margin ratio. You had 150,000 in the contribution margin, 300,000 in sales. That's how you came up with the 50.50. So 90,000 divided by the 0.50 is 180,000. So for that segment, it's 180. And then for the computer, we would do the same thing. So we have 80,000 as our fixed cost that's traceable to that segment over the contribution margin, which is 120,000 contribution margin over the sales of 200,000 to get the 0.60. So nothing too complicated, right? Y'all can remember those. Those are pretty easy formulas, right? Take the contribution margin divided by sales, and then take the fixed cost, which is only the segment or the company, depending on how the question asks, and then you divide it by that contribution margin ratio to get your sales. Okay, so notice that the 25,000 is excluded from the segment break-even calculations because the common fixed expenses are not traceable to the segments and are not influenced by the segment levels. So you would just not include those. If you're asked to do the segment, just don't include those common expenses that you can't trace to one of those segments. All right, so costs assigned to a segment should include all costs attributable to that segment from the company's entire value chain. So this is just a little example of what can make up the value chain. So R&D is research and development. So think about like a pharmaceutical company, do a lot of research and development. We have product design, manufacturing, marketing. Then we have distribution. We have customer service. So So you have your research and development, which is where you start doing research, you start developing the product, you start trying to see like how you can use this, how does this work, come up with a product design. A lot of times you'll go to investors with product designs and say, okay, this is what we've done, this is the research, these are the trials, whatever it is. And then once you have your product design and it's approved, it goes into manufacturing. So you can produce the product now that you have gone through all of the research, you've developed it, you've got your product design, it's been approved, you got your investors. So now you're manufacturing, and then you have to sell it, right? So how do we sell it? We need marketing people to go out and sell the product. And then we got to figure out, how is this product, now that it's produced, how is it going to be distributed out? So a lot of times with car dealerships, manufacturers, they're all over in different countries. So we have distribution sites all throughout the world, right, for those cars. So we have different distribution sites that come in here in the United States. They'll bring those cars in, and there may be several, so that they can put them in different areas, so that those are the distribution centers that go out to all of the dealerships in those areas. And then we have our customer service. So once you have the product out there, now you want to back it up with your service. That's the part that aggravates me, when they don't follow up with the service behind the sale. Unfortunately, there's not a lot of good service these days in all industries, not just one. I think one that's doing really bad is the fast food industry. I don't know what's happening with fast food, but it's not fast anymore. I don't know if y'all noticed that. And it's not cheap. You can go spend, same amount of money at a po' boy shop than you can, like, McDonald's. All right, so failure to trace costs directly. So costs that can be traced directly to specific segments of a company should not be allocated to other segments. Well, that makes sense, right? We don't want to take the cost that's for this department for bikes and turn it over to, what is another thing? Not a bike, but one of those scooters. So if you have costs that are for the bike, you don't want to roll it into the scooter, because then you're messing up the pricing on that particular unit. It could look like the segment's failing when it's really not. So it's important to make sure that those costs are accurate and they're going where they're supposed to go, which is kind of the same thing you've been hearing probably through, the other accounting class too, how we talk about, you don't want to, have a sloppy accounting department, but you have all this information going in, and then it's not really worth anything, because it's messy. It's not in the right place. You don't have it in the right segment. You can't make decisions. So you see, if you have information that's not good, you're not making good decisions. So we want to try to make sure everything's as accurate as possible. So if someone sent you in marketing paperwork, and you had to, help in, maybe you're helping in the team that's coming up with how much you're going to sell it for, how much advertising you're going to do, you have the wrong cost because of everything that was in there, and you price this too high, it's not going to sell. If you price it too low because you don't have all the cost added, and you put it out there, what happens? Then you produce and selling probably a bunch, you're making no money. It's not worth it. So you want to try to have accurate information. And then inappropriate allocation base. So some companies allocate costs to segments using arbitrary basis. So basically they're just saying, okay, let's cost it like this. And it doesn't mean that that's accurate either. So if they just do that, then it could cause that segment to look like it's losing money or not allocate correctly. So costs should be allocated to the segments only when the allocation base actually drives the costs being allocated. So we don't want to put things in to those segments that shouldn't be there. Common costs should not be arbitrarily allocated to segments based on the rationale that someone has to cover those costs. So you will work with people that think this way, that, okay, we got to just cover it somewhere, just stick it over here or stick it there. And it's not good. So one reason is because the practice may make a profitable business segment look unprofitable, which we just talked about. You have some extra costs in there and it's not profitable. And it could be because, the sale price that is being set by the teams that come up with those pricing based on the things that are not correct they're looking at. Or allocating common fixed costs forces managers to be held accountable for costs they cannot control. So if you're in a department and you're responsible for your costs, so let's say my husband works at a plant and there's all these different segments because they're producing all different kinds of chemicals and products. So if I'm over the product melamine, you know what melamine plates are, right? That plastic, they produce that there. So if I'm over that plant and acid is doing something over there, pneumonia is doing whatever and blowing up pipes, because that happened not too long ago, a couple of weeks ago. They're doing all that. I don't want to have, I don't want to have some of those costs over in my department, my plant, my segment, because I can't control what they're doing over there. I can only control this area here. So you don't want to allocate things to managers that it's out of their control, because a lot of times these managers, they have bonuses tied to production, bonuses tied to safety, bonuses tied to certain costs. They keep those costs down. And so do you think you're going to have full, the word I'm looking for, not devotion, but from your team members that are in that department, if they know that that kind of stuff's going on, they're not going to be fully committed, right? You want people that are going to stay fully committed. Hopefully a lot of y'all will be in management after y'all graduate. So you want to make good decisions. Okay, so we have Hoagland Lakeshore. So they prepared their segmented income statement. So we have a bar and we have a restaurant. We're separating them out because we want to see, which one's more profitable. So we have the restaurant that's more profitable than the bar. Might be the other way around here in New Orleans. I don't know. I think the bars might make more money than the restaurants. All right, so we have 244,000 total for the Hoagland's Lakeshore, and that's our margin coming in. But we also have common expenses that are not traceable to those segments. So our net operating profit is only 44,000. All right, let's see if we can answer a question. So how much of the common fixed expense of 200,000 can be avoided by eliminating the bar? So this common expense here, how much can be eliminated out of that if we get rid of this segment? None of it, some of it, or all of it? None, because it's not traceable to the bar. So we can get rid of the bar, but we're still going to have that 200,000. That doesn't help us get rid of any costs. All right, so suppose the square feet is used for the basis of allocating the common fixed expense of 200,000. How much would be allocated if the bar occupies 1,000 square feet and the restaurant is 9,000 square feet? So we have a total of 10,000 square feet. We have 200,000 in fixed expense. We want to allocate that by square footage. So how do we calculate that? So what's the total square feet for the bar? 1,000. Let's do that. Okay, so we have 10,000 as the total, and we have 1,000 as the square feet for the bar. So we have 1,000 divided by 10,000, right? Times, well, I'm gonna do times the 200,000. Which is just 10%. So we're going to have 20,000. So if we were to allocate that fixed expense that's not traceable and you wanted to allocate it, that's what would happen. You would have an additional 20,000 that would go to the bar. Let's see. So if Hoagland's allocates its common expenses to the bar and to the restaurant, what would the reported profit of each segment look like? So now we're going to do it. We're going to take that common expense that we can't trace and we're going to allocate it. So what happens? So now we put the 20,000 that we just calculated here. The remainder goes to the restaurant. So they both obviously are going to be reduced, but look what happens to the bar. It looks like it's losing money now. But can we get rid of that if we got rid of the bar? No. All right, so do you think the bar should be eliminated? Yes or no? No, because even if you get rid of it, the expenses are going to go away. So you're allocating something there to that segment, and you're looking at it thinking that it's losing money, but it's not. If you really know how to read the reports that you're looking at, you can see how much you're making overall when you do a combined income statement. So we have this situation with properties. We have several properties that are owned by one entity, but the way we have it broken out in our system is by property. So I'm running financials and I can look at them individually and I have all the expenses and income for that property. But when I do my combined financial statement at the end of the year, pulling everything in together, and I'm looking at what was my total net operating profit, right, for all of those properties, but I can look at them separately too. So if you allocate it on that and you're looking at this report, I'm not sure how much that really helps you out because it's not something that's going to go away if you were to get rid of the bar. So the answer would be no. So the profit was $44,000 before eliminating the bar. If we eliminate the bar, the profit drops by $30,000. And why does it drop by $30,000? So can you figure that out? How much was the bar making before? Well, that was what we were selling. So let's see if we can calculate out what they were saying at 30,000. So we have 14,000 that we were making from the bar. So this is what we're looking at with both 44,000. So if we had to eliminate the bar, we're not eliminating anything with this 200,000, that's staying the same. So we have to take our profits out of that, which is 30,000. So we reduce it down to 30,000. Let me see if that's what it said. If we eliminate the bar, profit drops to 30,000. So that's right. Okay, so I don't know, this is really something that I'm going to ask you, but I want to let you know that both US GAAP, remember GAAP stands for that generally accepted accounting principles. That's what we follow in the US. And IFRS is that international financial standards. So they have the international and you have US. Sometimes they differ on things. So when I'm like, if I have a company that is international, I may have to change some things on how I do my books here in the United States to present internationally. So they sometimes don't agree, but for this, they require absorption costing for external reports. So the absorption costing, remember, is taking some of that fixed cost and putting it on the units. Remember that? So, so for my external reports, that's how it's got to be presented. So if I'm looking at financial statements that are by contribution margin, I'm going to have to change that for that external reporting. I can use it internal. However, you may not want to do that if you're a publicly held company. So there was something in here, and I'll read it to you in a second. So we just talked about this, our absorption cost, and we have that manufacturing fixed cost that's getting added to the product. So it's going to go with the product either in inventory or when it's sold. And then we have both GAAP and IFRS require publicly traded companies to include segmented financial data in their reporting. So if they are a publicly held company, they have to report it by segment. So you can see the different segments and how are they doing, how are they, you know, what does it look like for each one of those segments? They have to do it that way. And it says companies must report segmented results to shareholders using the same methods that are used internally. So if I'm doing the contribution margin internally, if I'm doing my financial statements that way, then I have to present that. I have to show the investors that this is what, this is how we're looking on the reports. And so you may not want to do those. If you don't want to have them see them, then you wouldn't do it that way. You would only do the other approach. So it says this requirement motivates managers to avoid using the contribution margin approach because maybe you wouldn't want people to see that. And that's why you wouldn't do it internally, because they would be required to do it. So I thought that was kind of interesting, that if they're publicly held, they have to show it that way. And that is the end of chapter 6. So I don't think chapter 6 was too bad. So we got, the concept down last week when we did the contribution margin and the contribution margin ratio, looking at the costs coming in, how you calculate those. We did a bunch of scenarios, changing the quantity and stuff. So this week with the absorption costing, you just have to remember that a portion of that fixed cost, that variable fixed manufacturing overhead, that fixed manufacturing overhead cost is getting added to the variable manufacturing overhead cost. So that becomes part of it. And so, so there's a homework assignments that we'll go through, walking through the segments. I'm not exactly sure how I'm going to ask the questions yet on the segments. So I'll put examples up this weekend that I want you to know how to do it. So, there's a lot in the homework. And so those problems may be a little bit more difficult. So some of the easier problems will say calculate out like per unit, or calculate out the contribution margin, or contribution margin ratio, or one step. And that's probably more what the test is going to be like. But I'll make sure to have an example of the different problems and how they're going to be on the test. So do y'all have any questions?